Welcome to On the Mark, Financial Literacy with Mark Zinman. We're excited to offer you the next installment in this multi-part series on end-of-year tax planning considerations, including end-of-year employee bonus regulations. Right, and this is what you were saying at the top of today's episode, that there should be no surprises. So as an HR professional, message to supervisors, so that there are no surprises, please be clear as to whether you are grossing up the $500 or if they will be netting less, because you don't want for anyone to be disappointed, especially because, and if you are a small business owner and you are giving a discretionary bonus, it's not comfortable for either party. It's not comfortable for the employee to have budgeted for $500 bonus and then not gotten it. And it is not comfortable for small business owners to think that they are being generous, and yet in response to that generosity, they're being met with a complaint. So this just again circles back, top of episode, no surprises, and to be clear and intentional in your communication.
I'm very anti-bonus, okay? Because bonuses are then if you give a bonus once, it's expected again. So you definitely need to make sure, if you gave a person $500 one year and they work for you and you gave them $450 the next year, you may not remember, but they did. And therefore, the value of that gift is now diminished by the fact that somehow they felt they're worth less. So we always want to be very, very careful when we give some kind of a bonus, because that's what somebody's going to expect to be repeated next year, even if you tell them at the time it's a one-time. Right. Even, a traditional thing when I was in accounting was getting tax season bonuses, right? You work whole tax season, and if you stay all tax season, you get a bonus. Well, if my bonus was less in one year than the next, why would I, want to work there? I work just as hard. Shouldn't I get more? So you have to really think about it from the employee's point of view.
Yes.
And it's just a communication skill and a consistency skill. It's funny because I always get clients that call me up with I have this great idea of how to sell more. I'm going to give everybody 30% of this and 40% of that. I'm like, before we get into any of this, we better make sure that it works out mathematically, that you never stop it. Because you can't give them 30 1 week and then say, well, that didn't work out. I'm losing money. Now I'm going to give them 15%.
And I don't think that we're prepared to sidebar this far away from the topic on today's episode, but it would potentially be a great episode for the future, which is when you are a small business owner or a member of an executive team and you are preparing a formula that will be used to determine how much someone will receive in a bonus if it's driven by KPIs and not discretionary. We always, the big red flag, the big thing we need to avoid is making sure we are not incentivizing our workforce to do something that is not in the best interest, or not aligned with, I should say, the best interest of the company. For example, if you incentivize someone in sales, if you tell them you will get X amount of dollars based upon incremental revenue that you generate for the company, then they have that incentive just to bring in more business at any cost. What you want is increased revenue with the same or better profitability. So you can imagine if someone sells an additional $5 million worth of product, but with each sale, the company loses money, you have misaligned what is good for that sales representative with what is good for the company. So I would encourage anyone who is creating a bonus structure for their workforce to consult with an HR professional or an accounting professional, and to make sure that what is good for one is good for the other stakeholder, and that there is no misalignment.
Gross sales is amount, and net profit is what you do after the cost of what you're selling. So You always want to do it, based upon your, what happens if they gave somebody a volume discount? You got to give them the same rate as if they didn't give them a volume discount. So
Right. Okay. So is there anything else that you would like to share today with individuals or small business owners that can help them minimize or eliminate surprises, or help educate them on what they could manipulate and as they look for tax savings in this coming?
You need to determine whether or not you need to do so. So first of all, you can't fix your taxes in March. Okay, once December 31st comes, you're done. So you have to do it ahead of time if you want to do any manipulating at all, even buying stuff that your computer is what we use for an example. So you have to figure out what you can do and then what you want to do. Okay. And keeping in mind that each year dovetails into another one. Right now, if you're in sales or like I have real estate agents as clients, right? Well, they don't know what next year is going to be. So sometimes we might want to be a little aggressive this year. But if you know that you have a strong backlog next year of whatever you're working on, then, if you accelerate your payments by $50,000 or $100,000 in 2025, in order to get exactly where you were, you're going to have to do the same 50 or 100 in 2026 just to get back to where you were. And you have to have an incremental over that to get an extra benefit in 26, everything being equal. So just keep in mind that we're just doing a timing difference, and eventually it'll resolve itself back. It's the same thing we talk about. Sometimes clients have hard times understanding why they have more or less money in their bank than their profit. A lot of it has to do with things like depreciation, right? So you go out and you buy a car for $50,000 and you borrow $50,000. You can't write off the whole car, but maybe the bonus depreciation for that car is $20,000. So now you have a $20,000 deduction, but maybe you only made one car payment. And you say, okay, well, and nobody ever questions that. The next year, when you paid the $20,000, when you paid the rest of the $30,000, and you go, what happened to my $30,000 deduction? Then they all of a sudden remember. So the prepayment of expenses is a timing difference. So that's obviously a convention we use. The biggest convention is to understand where you are in 2025 with whatever steps you're going to take or not going to take. Okay, and there's lots of stuff we didn't accelerating your pension, your 401ks. There's a bunch of stuff that we could talk about that we didn't, but you basically have to go through your entire financial portfolio, both as an individual and as a business owner, and try and figure out where you are and then what you want to be. And it's money's very emotional. We talked about before. This is a very logical approach, right? We're going to be logical and unemotional and try and figure out where we are.
Okay. Thank you for that, Mark. And I would invite anyone who is listening or watching today to go to onthemark.cpa, because we do have some tools, some assets there for you that lists out some possible areas where you could make some adjustments to manipulate your income. Do you want to, before we close today's episode, talk about what we mean by manipulate your income?
Yeah. So, you and I had this conversation before we started this.
We did.
Manipulate sound good. Manipulate's not like it's not a criminal word. Okay. Manipulate is you want to have an out. You want to adjust what you're doing to have an outcome. And, paying your bills faster is not something you're not allowed to do. And paying them slower is not something you want, other than maybe getting late fees. It's not something you do. But basically, we're talking about you're trying to control what your income and therefore your taxes are by taking certain steps. All the steps we talked about, they may be applicable to you or they may not, but some of them would be. And so you're just trying to have no surprises and come out with something that you understand, and you understand the consequences and the reward of what you did to get to that place. And that's all we're really talking about. And the biggest caveat is just don't spend money you weren't already going to spend. It's not a time to go buy, stuff that you don't need just to get a tax deduction, which is something that comes up every year with clients who are more concerned about paying taxes than what it costs them not to pay taxes.
Well, thank you, Mark. As always, very insightful, very helpful. We want to thank everybody for tuning into today's episode. Let us know your thoughts down below. And as always, don't forget to like this video and subscribe to Mark's channel. We hope everyone enjoys the rest of their day, and we will see you next Wednesday.
All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.